Turning to tech, rebounding from Friday's big sell-off, Twitter halted for pending news after our own David Faber reported that CEO Jack Dorsey will step down. Joining us now is Jefferies senior tech analyst Brent Thill and Cowen senior research analyst Krish Sankar. I want to get into the broader moves we've seen throughout the tech sectors, guys. But Brent, I got to start with you and the fact that we do have these headlines about a change in the guard, so to speak, at Twitter. You cover the stock, your expectations about what that succession plan could potentially look like and what it means for the company.
Good morning. Yeah, I think it's a good thing. Obviously, Twitter's been underperforming materially. Facebook, Snap, and a number of the other names that we cover have had material outperformance, and Twitter's had multiple concerns around quality of product, quality of inventory. They've certainly had numerous issues. This isn't one or two quarters. This has been over multiple years, and the stock's really underperformed. So I think this is the needed change. Clearly, this is what investors want, as you saw in the pre-market and currently now in terms of how the stock's traded pre-halt. So we think this is a step in the right direction. Ultimately, they still need to fix the product and improve the efficiency for advertisers in the solution. So that's still, we have that to see what they do on the product side. But clearly, this is, I think, ultimately for investors, a step in the right direction.
Okay. And just to expand this out, Krish, I mean, we have seen most semiconductor names performing pretty well in recent weeks, if not in recent months. Given the fact that we have this new variant and all these question marks around this new variant, and you're starting to see, I guess, I don't want to say shutdowns or lockdowns, but you're starting to see some crimping of the flows of people to different parts of the world right now. And potentially, if you continue to see rising COVID cases, I would imagine goods. What does that do to the supply chain for semiconductors? And by the way, for Apple, that's already so strained.
Sure, Morgan. Thanks for having me. I would say two things. Number one, what you saw last year, and also as recent as July, late June, early July, where there was a spike in COVID cases in Malaysia, a lot of the supply chain got shut down. That did have an impact on the semiconductor distribution because there is quite a bit of supplier concentration in Asia, especially in places like Malaysia, Vietnam, Philippines. So I would say that any kind of spike in those specific areas could have a slight negative impact on the supply chain, which is already stretched given all the component tightness and the lead times. I think if you extrapolate that to Apple, obviously, in the long run, it might be a challenge for Apple too. I think it's a challenge for everybody. But I would say in the near term, into the December quarter, I think Apple probably has enough component supply to at least meet, I think, where the consensus is forecasting, which is about a 7% growth year over year in the December quarter. So I think in the near term, I think the December quarter into maybe March numbers are fine. But if this prolongs, I think it's something to worry about, given that it could crimp an already stretched supply chain.
Brent, you have a large coverage universe, and we have seen more broadly, even before all of the news of this new variant, a pretty large downdraft within software and cloud stocks. Are there buying opportunities at these levels?
Yeah, we think there are. And what's been happening is you've seen the market condense into a handful of names, Salesforce.com, Microsoft. You've seen a flight from higher multiple names, Asana, Cloudflare, names and runs. I think you're seeing this consolidation to the strongest get stronger. So ultimately, we think that some of these names still represent an opportunity. I still like the large caps. We've talked about the 4 large cap picks we like: Adobe, Microsoft, CRM, and Intuit. Just great recurring stories that have had multiple years of great outperformance, and those are the safe names. We look at companies like Vimeo, who has effectively seen a high of 60 and a low of 20. That story, below 20, I think is really interesting. IronSource, a SPAC below 10. We like the story around the mobile gaming and app ecosystem with Tomo Bravo involved, which is one of the best software investors on the planet. So that's a great story as well. So we think, yeah, there's a handful of names that look interesting. Again, I think you're seeing this consolidation play back to the larger vendors, and it makes sense. Ultimately, in the internet too, you look at Amazon's underperformance relative to Google going into 22. We like the setup there.
Krish, I'm going to put the same question to you based on your analysis. What's on sale in your coverage?
Sure. I think, Morgan, if I look at on the semiconductor side, I think, the semi-equipment names that I cover, I really like them. They are your classic picks and shovels scenario, or like the arms dealer in a growing semiconductor ecosystem. You have the cyclical bias, which is very strong. You also have the onshoring, or the silicon sovereignty from different governments that kind of helps. And then on top of it, there are some technology trends that benefit names like Applied Materials or Lam Research, or even ASML, which is in Europe. I would say that these are names which have a long and strong bias if you take a long-term lens. Apple, we obviously like it. We understand that, in the near term, there's always data point driven investing that impacts the name. The last few days, data points have been positive. But I think from a long-term trend standpoint, Apple is an amazing cash flow generating machine.
Shepard Smith here. Thanks for watching CNBC on YouTube.